Hey traders, welcome to Charts and Coffee. Happy Thursday, everybody. Hope everyone is taking a look at this post. Now, we had the advanced GDP come out this morning, as well as the weekly initial claims, the weekly jobless numbers. So both of those are hitting the indices, treasuries, gold this morning. And if you take a look here, this is a little sliver of a chart on the left edge there. That is the 5-minute chart. Let's open that up just a little bit so you can see this is the S&P reaction. Here's your 8:30 candle. So generally a bullish reaction to that data, but we are going to open this morning below yesterday's close on the S&P. If you take a look at the NASDAQ here, similar story, launch higher on the data, but still a heavy day. One of the things, and by the way, not in any way are we going to set about thinking that trading is prediction. I've never thought that's what it is. My job is managing risk on the way to a target. That's all that trading is, right? Can we justify holding a position on the way to this profit target that we want? But if I were looking at, and we did this yesterday, if I were looking at the close and we kind of are flat, or maybe have a little bit of a bounce the last 20 to 40 minutes before the close, I would think, all right, the bulk of the selling is probably out of the way. Things were calmer into the 4 p.m. cash close, and we could just kind of get to maybe an inside day or maybe a recovery day the next session. But if you'll notice yesterday, we were actually heading down towards lower lows, hitting the daily price movement range zones, which are actually still kind of doing a pretty good job holding. But we had a very heavy close. In other words, those last 20 to 40 minutes were, for the most part, pretty heavy. And that typically just means that we're going to see a little bit more weakness into the open, which I actually hope we do, because there are a number of things that I wanted to buy. I didn't want to buy them yesterday into that heavy close, but we'll take a look at them during the clearing or even the initial balance. Or in other words, the first 30 to first 60 minutes of the session, we'll take a look to see what the zones are and whether or not pullbacks within uptrends are still valid. But we are seeing far fewer uptrends. I mean, this is a fact. If we take a look at where we are in the NASDAQ, we take a look at where we are in the S&P, the Dow, the broader participation that we were seeing through June and even early into July, probably a week before OpEx this month, things are still pretty darn strong. So, let's put into context. Options expiration this month, the third Friday of the month, was the 19th, right? And that's right. I don't need this here. There we go. That's right here, the 19th, right? So going into options expiration, Wednesday, Thursday, Friday, we sold off into OpEx, and seeing that kind of gravitational pull to those high open interest strikes, that's not super unusual. And, all we really had was a mean reversion. But as we've progressed past a little bit of a bounce, right? And then what's happened? We've had another wave of selling. Now, yesterday's wave of selling, especially in the S&P and the NASDAQ, we could probably say, hey, that was an earnings reaction. So for as much as a very small number of stocks can carry the broader averages higher, on the flip side, gang, it works the same way. A very small number of stocks can carry an index lower. And you can see the NASDAQ took it pretty hard. In fact, the tech weakness, semiconductor, technology, communications, Meta and Google have been kind of a mess, right? You can see the NASDAQ's been taking it harder, not as hard as the S&P. All right, how is the S&P getting maybe a little bit of a pass? Well, it goes back to waiting, right? XLF had its breakout through 42.5 earnings and financials, which kick off earnings season every season, were pretty good, and it allowed the Dow to break out finally, and it allowed the S&P to benefit from the part of it that's weighted in financials. Another thing that's interesting, so, I think if we're looking at the Magnificent Seven and the Magnificent Seven alone, there's a reason for that, right? It's very influential on the NASDAQ. It's quite influential on the S&P, not as much on the Dow and not at all on the Russell. So when we take a look at healthcare yesterday, healthcare didn't give a rip about Tesla or Google, or any of these magnificent sevens, right? It didn't give a rip about them because yesterday Johnson and Johnson took off. So remember, it's not always that everything is going to move lower together or that everything is going to move higher together. It's always understanding where is the stock weighted in the sector and where is the sector weighted in the index. So there are some things that are actually moving higher or at least holding, just not as many things as there were just even 2 weeks ago. One of the things that one of our members brought up in the Sector Secrets Mastery was we spent a lot of time getting into the nitty gritty of what is the VIX and do we care and what does it really say? Now remember, the VIX is a tool that's considered to be a 30-day look at, well, it's a fear gauge, right? That's what it's kind of nicknamed. And in April, thanks to a handful of Fed members, that fear gauge went bananas, right? It not only took out the range that was right around 15 and a half, 16, it shot all the way up to darn near 20. Okay. And that was when a handful of Fed members said, oh, we might hike, which was ridiculous. But all of a sudden, you and me, we had to start thinking, oh, is that what's going on within the within the Hall of Justice? I always imagine the Federal Reserve is like the Hall of Justice and Super Friends, and they're all sitting around that table, Saturday morning cartoons. That's what I imagine. So we had that, and then things calmed down when Fed Powell said, no, we're not going to hike. So hikes are not on the table, or whatever he had said. So now on the 18th, 19th, when we were getting that pullback going into OpEx, we kind of shot to and through 15 and a half to 16, which in and of itself, that's a pretty reasonable pullback. In fact, remember when you looked at the S&P a moment ago, when the VIX was moving up towards 16, all the S&P did a mean reversion basically to the 34 EMA. And then things calmed down for a bit until, boom, yesterday, yes, now we are in VIX territory that takes us above that 15 and a half to 16. Now remember, this is a look at the SPX options, SPX, right? So you think about what's weighted in the S&P. You think about the sectors that are most affected. Does the Russell really care? Does the Dow really care? I mean, everything is going to have some reflection of risk appetite and risk aversion generally, but don't paint the whole market with the same brush is what I always remember. And so I'll try to find trends that are still intact. And by the way, if you're bearish, there are a handful, not that many, but there are a handful of downtrending names. Please don't pick the strongest things to short, right? Find things that are already wobbly, things that are under the equator, things that are in the bearish hemisphere, if you will. Say, okay, these would be eligible for shorts or long puts on rips, right? And that's the way that I would look at that. Okay, so that's a quick breakdown of what's going on right now. It's never a time to panic. Look, we're traders. Give us up, give us down, just give us some structure. And I will tell you, the toughest, and I'm telling this from 30 years, and I will tell you, I don't know anyone who's solved this riddle. One, we don't know which correction is just going to keep right on correcting. We can measure it. We can try to understand it, right? You see, I have this sandy check percentage gauge just to keep, within the popular thinking of 5% pullbacks, 10% pullbacks, 20%, which are so arbitrary, but we all think they're important milestones. All right. The next thing I want to remember is we know corrections can keep right on correcting. That's not the probability, right? That's not the probability, but it can happen. So it's a rarer instance. The other thing is, quite frankly, transitions from trend to chop is always going to be difficult. There is no way to, one, predict it. I'm telling you right now. And two, it is always going to be difficult. And I'm telling you this after 30 years of saying, Rob, is there a way to do something with this? I can't predict it. You know how you handle it? It's called a stop loss. All right. It's called a stop loss. So those are things we just have to accept, that there's going to be that one last trend trade. But let me tell you this, for anyone tells you it's time to panic, open up the whole year, right? That's what we've done this year. So is this a pullback kind of on par almost maybe with April? Not quite. It's not on the news of federal members, rogue members, talking about rate hikes. We are actually cruising into less than 2 months from now, probably the first rate cut. We're going to have the PCE tomorrow. So you might say, okay, Rog, I get it. No reason to panic. And if you're watching this show, you're not a panicker, right? You're not thinking prediction is trading. You know, managing risk to the target is trading, right? Not adding, not rolling over, not all those other things that are just that river called denial. All right, so now you ask yourself, I get it, Rog, but what could snap us out of this? Tomorrow's PCE would be a really big start. Tomorrow's PCE. And tomorrow's PCE is the release of the inflation gauge that the Federal Reserve uses in their models to justify whether or not they should hike or cut rates. So if we see that the PCE is cooler, that just continues to increase the probability that we're going to have that rate cut in September, which is well over 90% right now. It continues to be really high. Let me bring that up here. So here's your FedWatch tool. And here are the expectations for the rate cuts. Now, here's what gets interesting. I am by no means saying this is probable, but anything's possible. You'll notice that the rate cut column here, if we're at 525 to 550, we've gone down to 500 to 525, right? See this column here? 13%. Let's not make too much of it. But that means if the PCE is, say, way cooler, or we're just running into trouble, we're not ruling out a July 31 rate cut. I would not expect it. But what's happening is, at this point in time, gang, a quarter-point cut in September is fully discounted. Now the question, once we get the first cut, is how much longer are they going to keep cutting for? And we've got cuts priced in clear into April of next year. So first question is, when are they going to cut? Then the next question is, how much are they going to cut, right? And we're going to, after September, start transitioning into, well, how many cuts could we get? Where are we expecting rates to finally land? And rates are somewhere, the expectations somewhere between 4.25% to 3.75% to 4% from where we are right now at 5.25% to 5.5%. So first it's when, then it's for how long, getting us to what ultimate rate. So hard for me to be a bear in that regard. We're getting kind of an April month, which I will be straight up. I'll tell you straight up. April was my toughest month of this year. I will also say January and February, I probably could have taken the rest of the year off because we just had a bonkers up move. Those were fantastic trading months. Do I expect another surge after this chop like we had through May, June, and into July? I actually do. Not maybe to the same scale, but I'm still overall bullish. Now, here's the last thing that kind of ties everything up. And by the way, if you have questions, I'm just kind of rambling because there's no questions yet. So either everyone's waiting for their coffee to kick in, or maybe this is interesting. But the other part of this is, okay, we got the rate cuts out there. We got the chop that's happening and the pullback. Here's where traders get into trouble. From where I sit and from where you sit. Everything hinges on two things in a trade and analysis. How long is your time horizon? In other words, if I'm talking about all this to a day trader, it doesn't matter to them. They want to know what's going to happen over the next, between now and say 4 p.m. So the next question is, if you find yourself either confused or even in a disagreement with someone saying, this is what I expect the market to do, part of what they should do is say, hey, look, I'm looking at a daily time frame. Or, hey, look, I'm looking at the next quarter, or I'm looking into end of year, right? This is what the daily time frame would map to. This is what a weekly time frame would map to, whatever it is. So time frame and time horizon are a big part of the analysis. If we're really weak at the moment pulling back, we might see 1 hour time frames that are bearish. So do you see here? I could be neutral. I could be talking to you about the Russell saying, hey, we're above the previous session close, but we're neutral. That's a 5-minute assessment, right? I could be talking to you about the S&P and say, hey, we're below the previous session close, but we're neutral. Maybe a little bit bullish after GDP and initial claims. But someone looking at the 1 hour chart saying, Rog, what on earth are you talking about? This thing's in a downtrend. This thing's really heavy. We've just tumbled from 56.40 to darn near 54.40, right? You see the difference based on the slice of psychology? And the last one would say, Rob, we were in an uptrend. The uptrend's broken right now and it's really heavy. I'm in a bunch of chop, right? That's because you're looking at the daily time frame. It's like Goldilocks, right? Some porridge was too hot, some was too cold, some was just right. We have to know which time frame and time horizon we're pointing to. So mostly when I'm talking here in the room, I'm talking about the daily, because I see you all once a day. In the room, we look at two other time frames. By the way, this is why multiple time frame confirmation is, I'm not saying it doesn't work, but it doesn't work for me, right? Because the individual slices of psychology, I'm going to pick one. I'm going to pick a time frame and say, hey, if it's bearish on a 1 hour slice of psychology, that's where I'll work on. If I'm neutral on another one, or again, it's the structure on that time frame that's going to dictate what you do next. Okay. So it's not out of the question. It's not out of the question. See, look at the data, right? It's not out of the question that we could get a rate cut in July. But rather than saying we could get it, let's talk about the data, right? A lot of folks just don't like data. When you throw, you can talk to somebody and say 2 + 2 = 4, and they're going to argue with you about what 2 means. All right. So there's always that. But here is the July 31st target rate probabilities. 93.3%, we're going to get nothing, right? It's going to be a hold. Yes, 6.7% expectation that we could get a cut. Friday, tomorrow, the 26th, with the PCE, this has, for this to even be a conversation to be had, right? This has got to be more than 6.7%. But in the meantime, you can see, while that's slowly, and I mean very, very improbable, right? Possible, but improbable for the rate cut in July, it's something that some folks are starting to talk about, but not the vast majority. September is fully baked into the cake, right? So we'll stick with the data. All right. Next up is there any chance of the market going down if a rate cut happens? If a rate cut happens in July, Maruf, it's very unlikely, right? And would the market go down with a rate cut? There's a lot of ways people look at rate cuts that were unexpected. They look at it one way, which is cheaper money is better. So it's generally bullish. The other part that's sitting in the back of their minds is, what does the Federal Reserve know that we don't, that this looks like a panic reaction? So the Federal Reserve, if they don't see that it's baked into the cake, July rate cuts are very improbable. I want to at least acknowledge that the conversation is happening, but if there's 100 people in the room, 93 of them are saying we're going to hold, and 6 or 7 of them are saying we're going to cut. So remember, that does matter. It seems to be an expectation that rate cuts will favor the Russell. Rate cuts favor anything that likes lower borrowing costs. Rate cuts favor anything that likes a lower cost dollar. Rate cuts will favor anything where it encourages R&D, right? Lower borrowing costs, cheaper money. So I wouldn't say the Russell is necessarily the beneficiary of that. And here's why I would say BLP, anyone saying that the Russell is the one that's going to benefit, I would say it's just categorically not necessarily true. Because remember, rate cuts have been factored in to the Fed Fund futures to varying degrees since Q3 and Q4 of last year. It's the S&P and NASDAQ that took off. The Russell basically struggled most of the year up until recently. So no, I would not say that I'm going to say one sector, one index, they're all going to benefit from those factors differently. But I would say it's a general market behavior. So do I look at the Russell any differently because of rate cuts? No. In fact, the Russell's been a laggard this year overall, dramatically. So yeah. All right. On the investment cycle, euphoria to fear, what would I look at in economic data for the market to skip a full-blown down cycle? Jay, what would I look at to skip a full-blown? Well, I don't know. I don't know what a full blown down cycle actually means, Jay. I need to know the measurement. You're talking 20%. So I don't know because I don't know what that means in terms of a measurement. So I will say this: I don't see any evidence of it at the moment. NAS is taking the pullback the worst. Some of it's due to earnings, right? Um, I guess that a lot of folks consider a 10% pullback pretty dramatic. We're still pretty far away from that. 20%, I think most folks consider a crash. We're pretty far away from that too. So we're hovering somewhere between a 5 and 10%, call it a 7% pullback, and we don't even have a downtrend yet. Yeah. So I don't know what the different measure. Why do we call 10% a number? Is 9 not pretty awful? Why 20? 19 is not terrible. In terms of weakness. So that's where I'll say until I know what that means in terms of a measurement, does that mean we turn into a downtrend? I don't see evidence of a downtrend. Yeah, that I do not see. And by the way, look at the weeklies. The weeklies are hardly flinching, right? Okay, gang. So that's my take. That's my take. Thank you, gang. I'll see you all tomorrow, same time, same channel. Be good to each other.